Have you ever wondered what it feels like to stand in the middle of a burning building while the fire alarm is still silent? That is the psychological state of the American financial markets right now. It is a cognitive dissonance that separates the predators from the prey. Most investors look at a price chart and see lines, green and red candles, simple arithmetic. But an analyst who has survived the dot-com crash, the 2008 meltdown, and the inflation crisis of the early 2020s sees something else. They see the psychology of the crowd, and more importantly, they see the footprints of the giants. Today, we need to have a very serious, very technical conversation about what happened on the trading floor between December 11th and December 12th, 2025. If you consume your news from the standard financial cable networks, you were told that silver had a correction. You were shown a red ticker. You were told that the meteoric rise of the metal was finally cooling off. They pointed to the closing price on December 12th of 64.095 cents, noting it was down 0.77% from the previous close of 64.592 points. On the surface, that looks like a pause. It looks like a breath. But under the surface, something violent happened. Something that the algorithms missed, but the veterans caught. Let's look at the intraday mechanics of December 12th. The price tested a low of $63.13. In a normal market, a drop like that after a parabolic run-up would trigger a cascade of stop-loss orders. The weak hands, the retail tourists who chase the price up, usually panic when they see red. They sell. The price collapses. That is the standard physics of a market correction. But that is not what happened yesterday. When the price touched $63.13, it didn't slice through. It hit concrete. It bounced with a ferocity that suggests institutional intervention. And here is the data point that you must sear into your memory, the signal that Wall Street is conveniently ignoring. Volume. The average daily volume for a contract move of this magnitude is typically around 1,500 contracts. That represents the normal ebb and flow of commercial hedging and speculation. On December 12th, as silver tested that $63 handle, the volume didn't hit 1,500. It exploded to 18,400 contracts. Do the math. That is more than 1,100% increase in volume on a down day. What does that tell a 20-year veteran? It tells me that $63.13 wasn't a selling point. It was a buying target. Someone, or some entity, placed a massive limit order at that level to absorb every single ounce of paper silver that the market threw at it. This is what we call a hidden accumulation. While the retail public sees a price drop and gets scared, the smart money uses the liquidity of the drop to enter positions they couldn't buy on the way up without spiking the price to $70. This volume spike is the classic signature of a short squeeze in its accumulation phase. The shorts are trapped. They tried to push the price down to cover their positions, hoping to trigger a sell-off. But instead, they ran into a wall of buying so dense it absorbed 18,000 contracts in hours. This is FOMO, fear of missing out, but not from the retail public. This is institutional FOMO. This is hedge funds realizing they are on the wrong side of the most aggressive trade of 2025. To understand the magnitude of this breakout, we have to pull the camera back and look at the year-to-date performance. We are looking at a plus 126% gain since the lows of $28.31 earlier this year. In any other asset class, stocks, bonds, real estate, a 126% move in under 12 months is considered a bubble. It is usually the top. But silver is unique because it is correcting a 40-year suppression. The technicals confirm this is not a bubble, but a repricing. Look at the moving averages. The 50-day moving average, the standard metric for medium-term momentum, is sitting at $50.93. The fact that we are trading at $64, nearly $14 above the 50-day, usually signals an overextension. However, look at the 200-day moving average at $39.89. Throughout 2025, every time the price approached the 50-day, it didn't break down, it accelerated. The 50-day MA has been broken to the upside and is acting as a launch pad, not a ceiling. The year high of $64.32 is being tested repeatedly, and the failure of the price to reject significantly from this level indicates that the sellers are exhausted. There is a concept in behavioral economics called normalization of deviation. The market has normalized the price of silver in the 60s range in a matter of weeks. The skepticism of the UBS analyst team, who maintained a $44 target for Q4 2025, has been decimated by reality. Their models were built on the old world, a world where paper derivatives controlled the price. They failed to account for the physical decoupling. When a major bank misses a target by $20, it's not an error, it's a paradigm shift. They aren't just wrong, they are structurally blind to the new mechanism of price discovery. We are witnessing a blue sky breakout. Above $50, there is no historical resistance. There are no bag holders from 2011 waiting to sell at $60 because we blew past those numbers months ago. The only resistance now is psychological. It is the fear of heights. But the volume on December 12th tells us that the whales aren't afraid of heights. They are afraid of being left on the ground. When you see 18.4K contracts traded to defend a $63 floor, it sends a singular message. The big money believes $64 is cheap. Now, let's strip away the charts and look at the engine driving this train. Charts show you where the price is. Fundamentals tell you why it cannot stay there. And the why of 2025 is a story of terrifying mathematical scarcity. The defining narrative of our economy this year has not been inflation or interest rates. It has been the physical exhaustion of strategic resources. The Silver Institute, traditionally a conservative body that tends to downplay market tightness, has officially projected a deficit of 118 million ounces for 2025. On paper, that sounds manageable. It sounds like a large number, but one that existing stockpiles can cover. However, as an analyst who has tracked industrial flows for 2 decades, I am telling you that 118 million ounces is the sanitized number. It is the number that keeps the panic at bay. The real deficit, the operational deficit, is likely double that. Here is the smoking gun. Photovoltaic demand. In 2025, the solar industry didn't just grow, it mutated. With the passage of the aggressive grid modernization mandates in the European Union and the unexpected acceleration of the Sun Belt revitalization projects across the American Southwest this summer, demand for silver in PV panels exploded. We are seeing a 25% year-over-year increase in silver uptake by the solar sector. We are on track to consume over 700 million ounces of silver strictly for solar panels this year. Let that sink in. 700 million ounces. Total global mining production has barely budged. It sits at roughly 830 to 840 million ounces. This means that one single industry, solar, is now consuming nearly 85% of every ounce of silver pulled out of the ground in Mexico, Peru, China, and Russia combined. This leaves approximately 140 million ounces for everything else. Everything else includes the surging demand for silver in the new generation of solid-state EV batteries, which became the industry standard in Q3 2025. It includes the medical sector, which has ramped up silver-based antimicrobial coatings following the health scares of last winter. It includes the electronics sector, driven by the massive server farms required for the AI boom, which consumes silver contacts at a rate we didn't forecast 2 years ago. And it includes investment demand. There is simply no metal left for the investor. The pie has been eaten before it even reached the table. And what about the supply response? Economics 101 says that when prices rise, supply rises. Miners should be digging faster. But mining is not a faucet you can just turn on. We are seeing a meager plus 2% increase in mine supply this year. Why? Because of the grade cliff. The primary silver mines of the world are exhausted. We are digging deeper to find lower grade ore. In 2025, we saw major labor strikes in South America that crippled output for weeks. We saw stricter environmental regulations in North America that delayed 2 major mine expansions. The supply side is paralyzed. This brings us to a little-known fact about the technological shift of 2025 that the mainstream press ignores. Everyone talks about AI, but few talk about the hardware reality. The new HJT, heterojunction, solar cells that became the standard in 2025 don't just use silver, they use paste, with a much higher silver purity than the old PERC cells. The industry tried to thrift silver away. They spent billions trying to replace it with copper. They failed. The efficiency loss was too high, and the corrosion issues in the new humid climate solar farms were catastrophic. In 2025, the industry capitulated. They accepted that silver is irreplaceable. This inelasticity is the killer variable. If the price of silver goes to $100, Samsung and First Solar cannot stop buying. They have contracts to fulfill. They have government mandates to meet. They will pay any price. This is why the bounce at $63.13 was so violent. It wasn't speculators. It was industrial procurement officers panic buying physical inventory to keep their assembly lines running. We must also look at the recycling narrative, the safety valve that bears always point to. Scrap silver will fill the gap, they say. In 2025, we learned that was a lie. The complexity of modern electronics and the specific chemical composition of the new solar panels make recycling silver incredibly difficult and expensive. We are not seeing a flood of scrap metal hitting the market despite these high prices. The silver is locked in landfills or active use. It is gone. The 118 million ounce deficit reported by the Silver Institute assumes a certain level of scrap flow that simply isn't manifesting. If you adjust for the real recycling numbers, the deficit is closer to 200 million ounces. That is 25% of global production missing. Vanished. The market is currently operating on fumes. We are eating into the above-ground stocks at a rate that is mathematically unsustainable. When you combine a plus 25% demand shock in the dominant sector with a stagnant supply chain, you don't get a linear price rise. You get a vertical revaluation. You get December 12th. You get a market that refuses to stay down because the physical metal to settle the contracts simply does not exist. If the supply and demand data is the fuel, then the banking activity is the match. And there is no bigger whale in these waters than J.P. Morgan. For years, conspiracy theorists whispered about J.P. Morgan's silver hoarding. In 2025, it stopped being a theory and became a disclosed reality for those who know how to read the warehouse receipts. While publicly issuing bearish or neutral guidance on precious metals earlier in the decade, the bank's proprietary trading desk has been doing the exact opposite. Data from the COMEX and eligible vaults indicates that the J.P. Morgan hoard has swelled to a staggering 750 million ounces. But here is the critical data point regarding our current timeline. In the last 6 months alone, during this massive price run-up from the 40s to the 60s, they added another 21 million ounces to their vault. Ask yourself the psychological question: why would the most sophisticated bank in the world, an institution that practically invented modern commodities trading, be adding to their position at all-time highs? If silver was a bubble at $64, they would be selling. They would be distributing this metal to the desperate public. But they aren't selling. They are accumulating. This behavior suggests only one thing: they are hedging against tightness. They know the COMEX is drained. They know the London Bullion Market Association, LBMA, is running on empty. JP Morgan is positioning itself to be the supplier of last resort. They are cornering the market, not to suppress the price, but to control the industrial supply chain. When Tesla needs silver for its 2026 production run and the miners are tapped out, they will have to knock on Jamie Dimon's door, and he will name the price. Simultaneously, we must look east. The Shanghai Gold Exchange, SGE, and the Shanghai Futures Exchange, SFE, have been flashing warning signs all year. As of December 2025, silver inventory at the SFE has plummeted by 40% year over year, hitting a 10-year minimum. This is a critical divergence. In the West, we trade paper contracts. In the East, they take delivery. The arbitrage window is closed. Metal is leaving the vaults in Shanghai and going directly into factories in Shenzhen and solar parks in the Gobi Desert. China knows the dollar is losing its purchasing power. But more importantly, they view silver as a strategic national security asset for their energy dominance. They are draining the global float. The 40% drop in SFE inventory is the sound of the sucking sound of the vacuum effect. We are also seeing a shift in the gold-to-silver ratio that Heraeus, the German precious metals giant, predicted. They noted that silver traditionally outperforms gold in the late bull stage of a cycle. We are there. Gold has had its run, stabilizing the monetary system. Now, silver is catching up, driven by its dual nature as money and essential industrial input. The ratio is compressing violently. The historic average is around 60-1 or 50-1. We are heading toward 30-1. At current gold prices, a 30-1 ratio puts silver well north of $85. This explains the UBS target failure. UBS predicted $44 because they treated silver like gold, a purely monetary asset influenced by interest rates. They ignored the industrial desperation. Heraeus got it right because they looked at the factories. The 200-day moving average at $39.89 acts as the floor of this new reality. That price represents the cost of production for marginal mines, plus the risk premium of a chaotic geopolitical world. We will likely never see the 30s again in our lifetimes. The floor has moved up because the cost of energy, labor, and capital has moved up. The breakout above the 50-day moving average of $50.93 was the technical confirmation that the trend has changed from recovery to discovery. We are in price discovery mode. The market is trying to find the price at which holders of physical silver are willing to part with it. And right now, at $64, nobody is selling. The volume spike on December 12th proves there are buyers at $63, but the lack of selling pressure suggests the sellers are holding out for $75, $80, or $100. Wall Street ignores this because it doesn't fit their quarterly models. They can't plug 118 million-ounce deficit into an algorithm designed for a surplus economy. They can't model for a 40% inventory drop in China because they don't trust the data. But the price is the truth. The price is $64. The volume is record-breaking. The vaults are emptying. The signal is flashing red, and it is blindingly bright. The hidden breakout isn't hidden because it's invisible. It's hidden because the establishment refuses to look at it. They are waiting for a reversion to the mean. But when the fundamentals of supply and demand are broken, there is no mean to revert to. There is only the next level up. We are standing on the precipice of a 3-digit silver era. The events of December 12, 2025 will be remembered as the last time the smart money was able to buy the dip. The collision of the 118 million-ounce deficit, the 25% surge in solar demand, the hoarding by JP Morgan, and the draining of Chinese vaults has created a perfect storm. The paper price is finally being forced to acknowledge the physical reality. If you found this analysis valuable and want to stay ahead of the curve as we navigate this historic repricing of real assets, make sure you subscribe to the channel. The mainstream financial press will not tell you this story until it is too late. Leave a comment below. Do you think the $63 support level will hold through the end of the year? Or are we headed straight for $75? Let's get the conversation started.